Yeah, so some relief today for a Teladoc, but boy, the 1 month chart on some of those names is ugly, ugly. Oppenheimer making a bullish call on SVB Financial, Morgan Stanley, and JP Morgan today, upgrading all three bank stocks, saying each has around 30% upside potential in the next 12 to 18 months. And joining us now, Oppenheimer senior research analyst Kotowski behind the call. Chris, you think it just got overdone in terms of fears of slowdown and recession for these banks?
Well, if you look at it, last year banks were outperformed the market by about 700 basis points, and up through January 13, they tacked on another 1,000 basis points of outperformance. And what drove that outperformance was a simple narrative, which is that the economy is hot, and that's going to lead to loan growth accelerating, and it's going to lead to rising rates. And rising rates are good for bank earnings, and they're not good for growth stock multiples, so banks should outperform. That was the narrative all year long last year. The narrative now is that recession is a foregone conclusion. So you sell the autos, you sell the banks, you sell housing stocks. They've shot all the usual suspects. And I guess my point of view is nobody really knows about whether there's a recession that's imminent. You know, I was an analyst in 1994 when the Fed raised rates 6 times for a total of 300 basis points. And we had like 6 or 7 years till the next recession came through, and banks performed fabulously through there. And so what I would say is, A, nobody knows whether we're going to be in a recession, but the market is already discounting it in the price of the bank stocks. So that makes the bank stocks less risky now. And then B, I think the market is going to be really pleased by how well banks perform and how much they've de-risked their balance sheet since the great financial crisis.
Well, besides the higher, the rates and the slowdown concerns, there are also worries along with that about lending and whether that has staying power, about the capital markets and the drop-off we've seen in M&A and IPO activity. So what are bank earnings going to look like in this environment in the coming quarters? Plus the higher costs for everything from labor to general expenses.
Yeah, people focus on all these little nits, and they do not stand back and look at the fact that these companies have been consistently earning a low to mid-teens return on equity in all different kinds of environments for the last 6 or 7 years. And, what happened in the pandemic when rates came down so sharply and suddenly is that the commercial banks' return on equity dropped about 2 percentage points, but it wasn't catastrophic. The investment banks went up 5 or 6 percentage points. And, the outlook is that, probably for the next 2 years, they're going to be back in that 14-15% range on average, which is a great place to be. And you can make a lot of money here if you can buy a company that's earning a 14-15% return on equity at roughly half the market multiple and have it with a safe and sound balance sheet. Those are going to be good stocks.